A major update has just come out from one of the biggest investment banks on Wall Street, and it could reshape how you think about gold, silver, and copper over the next few months. JPMorgan released a new technical strategy report dated February 5th, and their outlook on the metals market is getting serious attention. Here is the headline first. JPMorgan expects a consolidation phase across the major metals. Gold, silver, and copper are all projected to move into a period of sideways, range-bound price action in the near term. But there is an important nuance here that many people will overlook. This is not a signal that the bull market is over. Their analysts describe this phase as a necessary pause inside a larger long-term uptrend. Think of it like a halftime break. The trend is not finished. Momentum is simply cooling off before the next phase.
Before going further, drop a comment and say where you are watching from today. Which country or region are you in? Also, share your view. Will gold make new all-time highs within the next 60 days? Or do you expect a deeper pullback first? I read every comment and want to know your honest expectation. Let me also clarify something important. I don't sell courses, signals, paid groups, or exclusive memberships. The goal here is balanced analysis, showing both bullish and bearish angles so you can make your own informed decisions. Many viewers have said this helps them filter out noise and focus on what matters. That is the purpose.
Now let's break down what JPMorgan's report actually says. The analysis comes from Jason Hunter, a technical strategist on their global market strategy team. His work focuses on charts, price structure, momentum, and pattern behavior rather than purely economic fundamentals. Technical analysis helps interpret positioning, psychology, and probability based on historical behavior. According to Hunter, gold's recent move looks like a typical short-term reversal after a steep rally, not the final stage of a long-term uptrend. He explicitly states that this is a pause, not a peak. That difference is critical. A pause means digestion. A peak would mean trend failure. JPMorgan is clearly in the pause camp. Gold recently experienced what is called a parabolic rise, prices accelerating upward almost vertically. Moves like that rarely sustain without cooling off. When markets go parabolic, momentum eventually exhausts and prices either pull back or move sideways to reset. JPMorgan expects gold to form a broad consolidation range over the coming weeks or even months, with large swings inside that range. In other words, expect volatility and choppy movement, not a clean straight-line trend up or down right away. They also outline key technical levels. On the upside, $5,000 is major resistance. Above that, the $5,100 to $5,150 zone is even stronger resistance and could cap rallies in the short term. On the downside, first support sits near $4,500, around the 50-day moving average. The stronger buying zone is identified between $4,264 and $4,381, which was a prior breakout region expected to act as support. To restate clearly, resistance near 5,000, stronger ceiling at 5,100 to 5,150, initial support near 4,500, strong support and buy zone at 4,264 to 4,381. These are the levels their technical desk is watching closely. Gold is currently trading around $4,467 per ounce, and silver around $77, placing gold roughly mid-range within the projected consolidation band. Despite the short-term slowdown, JPMorgan says the main long-term driver behind the gold bull market is still intact: currency debasement. Governments continue expanding money supply, running large deficits, and reducing purchasing power over time. Historically, that supports hard assets like gold. They also highlight the US dollar index remaining below the 100 level as a long-term bearish signal for the dollar. Continued dollar weakness would support higher gold prices. So the consolidation is happening within a still bullish macro backdrop. Another major signal they mention is the breakdown in the S&P 500 to gold ratio below a decade-long support line. That ratio measures stock performance versus gold. A falling ratio means gold is outperforming equities. Similar structural breaks occurred in the late 1970s before the historic metals bull run into 1980. History may not repeat exactly, but the pattern similarity is notable. Their conclusion is that capital rotation into hard assets is not finished. The current pullback is described as a mid-cycle pause to digest gains. Again, a halftime break, not a trend reversal. Now consider copper. JPMorgan separates precious metals like gold from base metals like copper because their drivers differ. Both may consolidate, but copper has an additional tailwind: pro-cyclical rotation tied to manufacturing and industrial growth.
Gold is crowded due to the currency debasement trade and profit-taking after its sharp rally. Copper benefits not only from debasement themes, but also from expectations of economic and industrial expansion. That dual support could allow copper to resume its uptrend earlier than gold once consolidation ends. They specifically expect copper to lead the next leg higher, potentially in the second quarter. After copper rose above $14,000 per ton, some worried it was ahead of fundamentals. Regression models suggest current copper pricing implies global manufacturing PMI near 53, while actual PMI is closer to 50.5. That looks stretched at first glance. However, JPMorgan compared copper with analog semiconductor stocks, which are highly tied to industrial cycles. Those stocks also imply PMI rising toward 52 by late Q1 2026. Since both markets point to the same recovery signal, JPMorgan views copper's strength as forward-looking rather than irrational. They say copper's pullback is technical, not a collapse in fundamentals. Copper levels. First support is expected in the 12,074 to 12,105 area as a tactical buying zone. Stronger structural support sits at $11,100 to $11,200, a multi-year breakout level. Holding above that keeps the long-term bull structure intact. Unlike gold, copper has not shown a sharp reversal signal. Selling pressure appears lighter and structure more constructive. Strategy takeaway: metals should not be treated identically. Copper and gold have different timing and drivers. Copper may turn up sooner. Now let's talk silver. Silver is also expected to consolidate, but it behaves uniquely because it is both a monetary metal and an industrial metal. Roughly half its demand is industrial: solar, electronics, EVs, AI infrastructure, and half is investment and jewelry demand. Because of this dual role, silver often moves with gold in monetary stress but also tracks industrial cycles like copper. It acts as a hybrid exposure. Silver recently experienced extreme volatility, including a 38% drop from highs followed by rebounds. Under a consolidation scenario, range trading is more likely than straight directional movement. Support-resistance mapping and staggered accumulation become more important than perfect bottom picking. Silver may stabilize somewhere between copper's and gold's turning points due to its mixed drivers. Now the big investor question: is consolidation a buying opportunity or a warning sign? The bullish argument says consolidation inside a confirmed long-term uptrend is a chance to accumulate at better prices. Currency debasement trends persist, dollar weakness persists, and structural ratios favor metals. JPMorgan's defined support zones offer potential value entries. The cautious argument says consolidations can be messy and extended. Prices can whipsaw, break support, and test patience. No technical level is guaranteed to hold. Analysts can be wrong. The widely recommended approach is staggered accumulation, spreading buys across levels and time rather than all at once. That reduces timing risk and uses volatility to your advantage. A fund manager quoted in the discussion advises not chasing moves and keeping metals as a supporting allocation, not an all-in core bet. Gradual buying beats lump sum entry in volatile phases. JPMorgan also comments on oil. Brent crude is expected to remain range-bound. Resistance sits in the upper 60s, with a sustained move above $70 unlikely near-term. Strong support appears in the 50s via clustered moving averages. Stable oil reduces inflation shock risk and removes one variable from metals pricing. Geopolitically, tensions remain. Trade frictions persist. Central banks continue record gold buying, and slow de-dollarization trends continue. These factors support the long-term metals case even during sideways price action. During consolidation, emotional reactions are dangerous. Have a plan. Know your levels.
Know your time frame. Short-term traders can trade the range. Long-term investors can ignore noise and accumulate selectively. Final key takeaways from the report. All major metals are entering consolidation that could last weeks or months. Expect range volatility. This is viewed as a halftime pause, not a bull market end. Currency debasement and dollar weakness still support metals. Copper is expected to resume its uptrend before gold due to pro-cyclical growth dynamics. Key levels matter. Gold resistance near 5,000 and 5,100 to 5,150, support near 4,500 and 4,264 to 4,381. Copper support near 12,074 to 12,105 and 11,100 to 11,200. Patience, discipline, and staggered buying are preferred over emotional or all-in moves. The metals rally appears to be resting, not ending. How you position during this pause may shape your results when the next phase begins. If you found this analysis helpful, make sure you hit the like button so more people can see it, and subscribe to the channel for in-depth updates on gold, silver, and copper markets. Drop a comment right now and tell me where you're watching from and what you think happens next. New highs first or deeper pullback? I read every comment. Share this video with anyone who follows precious metals. Stay alert, watch the data, and watch those levels. And I will see you in the next video.